Hey guys, welcome back. Today we're going to be investigating this apparent mortgage collapse, where many experts are claiming that very soon you won't even be able to get a mortgage because so many banks and mortgage providers will be going bankrupt. In this video, I'm going to be giving you my documented data on the severity of this crisis so you know the truth from, well, nonsense. So if you have a mortgage or you're looking to take a mortgage out in the near future or even refinance, then you definitely need to watch this video to make sure that you're fully informed. And as always, unlike a lot of these other finance channels, I don't just make outrageous claims. I actually do a ridiculous amount of research, sometimes reading 50 or more papers, as well as studying thousands of data points before I make the video for you. I do this so that you don't have to, so you can spend your time on what really matters, like Netflix and funny cat videos. So if you appreciate me doing this for you, please go ahead and click the like button below because it really helps me with the YouTube algorithm and giving this information to people based on facts and not fiction. All right, with that said, let's get into it. So what's the big deal right now and what exactly is going on in the mortgage market? So let's start with what we do know. A large amount of home loans and mortgages have been frozen across many countries. Many mortgage lenders have huge delays on processing mortgages, with some of them backed up for months. And in certain countries, like the UK for example, a home move right now, so if you want to move house, is illegal. You can actually be arrested for moving house right now. Surveyors can't even access houses or properties to actually do surveys and valuations, which is also putting the brakes on approvals because the banks need that survey, that valuation from the surveyor in order to approve the home loan. Do you see the catch here? But on the flip side, many house sales with valuations are going through at a rapid rate for two main reasons. Firstly, because many people suspect that even if they get their mortgage approved, their house actually might go down in value, but they're more afraid of not getting that mortgage in the first place and continuing on renting. And secondly, because many of them suspect that they might lose their job over the next few months. So they're really taking the lesser of two evils by getting on the housing market now, even though their house might drop in value. And of course, lenders are being stricter on who they give approvals to because they know there's a high risk right now with unemployment and that person may not have their job in a few months' time. Because lenders know that as the risk of unemployment goes up, also the risk of default goes up with it. And as a result, many people are simply just not able to get a loan. And if they get furloughed or their salary decreases, this is also going to have a knock-on effect for when they come to purchase their next house because they'll have less of a monthly payment, which in a worst case scenario can actually reduce house prices right across the country from city to county to state to any country wide. So if you have any concerns right now with a crash in house prices, I'll be covering my predictions on this in the next week or so. So just make sure you're subscribed to the channel and you'll get that video as soon as I release it. So overall, the banks have a very, very high risk with taking on any new mortgages right now, and they know it. This is why they are declining mortgage applications in record numbers. Moving forward, we're already seeing tighter lending policies, especially if millions of people are now going to be living off 80% of their previous earnings. Now let's talk about interest rates. The next thing you may be wondering is this. If interest rates have been reduced to 0.1% in countries such as the USA or the UK, for example, then why are the banks now charging higher interest rates? Shouldn't they have passed on these savings to you, the consumer? Well, not surprising to me, mortgage lenders have actually increased their rates. This is due to high demand, they say, but in my opinion, they should, and again, I use the word lightly, they should reduce these rates down again as competition increases with other lenders. They should then reduce their rates to counteract that. But again, just remember what I say in a lot of my videos, the banks are not your friend, okay? You've got to get that clear. They are not your friend, all right? They pretend to be your friend, but they're really not. So you've got to be careful and just do your own due diligence. So it's really a simple case of supply and demand right now. The banks know that a lot of people are afraid of losing their jobs, so they're increasing these interest rates And people, they haven't really got a choice. They either accept it now or they wait knowing they may lose their job and they won't be able to get a mortgage. So really, some of these banks are preying on vulnerable people, which, again, I talk about this a lot. You know me, I'm not a friend of the banks, except when I want lending for myself, but this is the way they operate. And the other reason that they're increasing these interest rates, I'll come on to this in more detail in a minute, is because they need to in order to pass off these loans to investors. You've probably not heard of this before, so I'm going to come on to it in a second. One of my concerns is that if credit does become more expensive, then house prices will have to fall in value in order to meet the market demand of buyers who have less money to spend. So right now it's either going to go one of two ways. And no one knows the answer to this challenge, despite some of these gurus trying to pretend they know. They don't know, okay? They don't know. But let me give you my thoughts on this. And remember, this is YouTube. This is just for entertainment purposes only. I'm not giving you financial advice. I'm not a mortgage broker or anything like that. Okay, so this is just my opinion from being in the real estate property investment market for the last 15 years. So number one, lending restrictions will ease up and the availability of credit will flow more freely with lower interest rates. And this is a good thing for you if you currently have a mortgage or you own a home or you own investment houses, because it means the value of these houses will stay about the same, roughly. Or number two, I'm just going to be blunt with it, if interest rates increase, lending becomes tighter and stays this way, there will be a housing crash. Of this, I'm almost certain in this current economic climate, and the central banks know this as well. You've got to ask the question, if we've had these average interest rates for most of civilization, why have our central banks been keeping the interest rates so low since the last recession of 2008 onwards? Why would they do that? It's because they know, they don't tell you this, but it's because they know that if they increase the interest rate, it's going to push the affordability of everyday people down. So what happens is when you can't afford a bigger house, because remember, people don't buy houses based on the price, they buy them based on the monthly payment. So what this does is it makes houses more expensive, people can't afford them, and it causes a crash. So houses have to come down to the level where they're affordable again. So let me just clarify, when I say I'm certain of this, I'm going off the data. Many people are not saying this, the experts aren't saying this, because they're going off stock market and all these other things. I don't go off the stock market. If you look at what causes recessions and depressions, the stock market isn't even in one of those 5 variables. If you don't know what I mean, watch the video I put out just a few days ago. That will cover it all for you so you understand. Some of these hedge fund experts talking about the housing market, they don't know what they're talking about because all they understand is the stock market. So what I'm talking about is actual facts that will give you this data, and this is what's going to happen with the housing market. It's pretty well documented now that the 2008 housing crash was caused by banks making really bad loans because they were getting greedy and they were going to the credit rating agencies and getting these AAA rated loans for pretty much anything.
Can you name one time in the past year where you checked the tape and you didn't give the banks the AAA percentage they wanted?
If we don't give them the ratings, they'll go to Moody's, right down the block.
They were then giving these loans to pretty much anyone. But this current crisis right now is not as a result of bad loans, it's as a result of unemployment and uncertainty. So let me just explain what happens when you go to the bank and apply for a mortgage. And I'll keep this really, really simple. Even though you may think that you're going to be paying the bank every month for this 20, 30-year mortgage and they're collecting the interest from you, it actually doesn't really work like that. The bank makes their profit from that upfront fee that they charge you for arranging the mortgage. They then package up your mortgage with some other mortgages and sell those on to investors. Now, this isn't the case in every single bank, mortgage, etc., but it's true for the most part. And during the 2008 crisis, the banks that had all these bad loans, these bad bundles, they tried to pass them on to investors. These investors who had bought these bad bundles basically tried to pass them on to other investors, because they wanted to get rid of their bundle like it was a hot potato. And the bank then started panicking because it realized that the investors knew that what they were selling them was, well, a load of So when the bank tried to offload these mortgages, they simply couldn't. This then resulted in the huge crash that we saw on TV, which sent banks like Lehman Brothers, who had operated since around 1850, into bankruptcy.
Monday, September 15th, 2008. Lehman Brothers files the largest bankruptcy in U.S. history, precipitating the global financial crisis.
But this time around, the financial institutions have learned from the mistakes of the past. Take this for example. My favorite private non-federal institution, the Federal Reserve, are offering to purchase all of these home loans right across the USA to replace those investors who don't want that hot potato. And since the Federal Reserve doesn't have any money anyway, they can just cover all these loans and the defaults with money that doesn't exist anyway. Again, adding to this huge pile of debt through quantitative easing. But there is one good thing about the Fed guaranteeing all these mortgages, and that is that it gives more confidence to the market and it keeps interest rates lower. And as part of the Fed package, they are also offering 180 days of mortgage forbearance, with a further extension of another 180 days if needed, which right now covers the majority of loans across the USA. But if you're like many people and you assume the Fed's going to pay, that's not quite true. The mortgage company have to pay first and foremost, and if they default, then the government will step in and they will be next to pay with their $7 trillion of relief package, which they got from the Federal Reserve. And if the government can't pay, then the Fed will finally step in and they will pay with their money. That's a pretty sweet deal for the Fed, in my opinion. I wouldn't mind taking ownership of all these property titles and deeds with created money. So finally, how do I think this is going to affect you then? Well, if you're like me and you've currently got all of your mortgages on fixed rate terms at low interest rates, then nothing's really going to change for you in the short term until that fixed rate comes to an end. But if you're in the market right now to refinance, to buy a new home, or you're looking to purchase a new home in the near future, then you may find that a lot more difficult. For example, you may only get offered a higher interest rate, and you also may have to put down a larger deposit. This is because the bank wants a better loan-to-value ratio for them to protect themselves if there is a downturn. This is especially true while there's a lot of demand for cheap money right now. So if you're living in the USA, right now you haven't got anything to worry about because you've basically got 3 lines of protection. And even though other Western countries haven't taken this same approach yet, I'm pretty sure that the central banks are gonna follow suit and offer something similar, because who wouldn't? And just to share a personal story with you from my life and my property portfolio, which I built between 2005 up to 2008, 2009 time, in roughly 2009-ish, when all of my fixed terms came to an end, which my mortgage advisor told me, oh, don't worry, you'll just be able to refinance and get a lower rate. They all say that, by the way. If your mortgage advisor says that to you, just take that with a grain of salt, because remember, they get a commission. So they're going to say that to you. Guess what happened to me? I couldn't refinance for a lower rate. My mortgage rate actually went through the roof. I went from a 4 or 5%, really nice rate at the time. At the end of the fixed term, it went from 8, some of them went to 10 or 11%. Can you imagine 10 or 11% interest rate on a house that was overvalued? So I was paying too much on a house that was now pretty much gone from overvalued to worth about 30% less across a portfolio of houses, and I couldn't sell them because I had mortgages that were worth more than the houses, so I was what's classed as underwater on these houses, and I couldn't refinance because I couldn't reach the loan to value requirement that the banks wanted in order to give me a good percentage rate. So just be really careful of this. So thank you ever so much for watching. You know me, I make these videos for you just to help you through these difficult times. And if you appreciate the 20, 30, sometimes 50 hours that goes into making every single video, please do me a favor and click the like button below. And I love to hear from you. Please leave me a comment below. Let me know what you thought of this video. Let me know what you think is going to happen. And remember, in my upcoming video, I'm going to be sharing with you what I think is going to be happening in the housing market in the near future. So until next time, stay safe, take care, and I'll see you soon.